Your CPA didn't tell you about using a C Corp for your business, did they? Nope. That's because they were taught that, C Corps cause double taxation. But in this money secret, I'm about to show you how when combined correctly with other entities, they can save you tens of thousands of dollars in taxes and give you unparalleled asset protection. And if this is valuable information to you, go ahead and subscribe here to this channel. And once you do, be sure to click the little bell on the top right so that you get notifications of our new content. In America, we have a bunch of different corporate entities that do various things with pluses and minuses. A C Corp has some really, really great pluses, like no C Corp member, or we call them shareholders, ever pays tax for the profits that the C Corp makes. That's pretty great. We call that no pass-through. Also, there's a flat tax on the C Corp, which means no matter what kind of income it is, capital gains or income or whatever, flat 21% tax. And if you're in a non-tax state, that is a cold, hard tax, and we love that. There's also two different kinds of shares that are available, so that if you wanted to have investors come in, they could have voting rights or not. It's very, very flexible. The bad side for a C Corp is that the only real way to get money out of there, other than the max paying tax of a W-2 employee, is via dividends. And dividends are indeed where your CPA is correct that there's double taxation. And because the company can't deduct anything that they pay you from those profits via dividends, you have to pay tax, the company has to pay tax, you're instantly at a 50% tax on both of those put together. Not so great. Also, C Corps and S Corps are like Venus flytraps for assets. Once you put them in there, it's very, very difficult to get them out of there. Conversely, an LLC, especially a multi-member one, passes through all tax to its members. So unlike a C Corp, LLCs never pay tax. Their members always pay tax, and that is, again, a pass-through entity. But in exchange for that, they have maximum flexibility where, depending on the bylaws and the minutes that you created, ownership doesn't have to mean control. Members get paid and get to benefit from the qualified business income tax deduction, and there's 4 different ways to get money out of an LLC, including a thing called a guaranteed payment. But combining the nature of an LLC with a C Corp creates powerful benefits for money you're leaving in the LLC. So imagine the LLC, again, passes through all of its taxes to the members, but what if the biggest member was a C corporation? C corporations have a flat tax. Now, when the LLC makes $100,000 in profit, let's say, that tax liability flows through to the C Corp where it pays a 21% flat tax. And the money doesn't have to flow through to the C Corp because the only way the money comes out of that LLC is by an affirmative vote of the managers. And if the managers say, we're not going to have distributions there this year, there's no penalty for doing that in an LLC, and the C Corp still pays the flat tax at 21%. There's obviously some provisos, and I'm simplifying it, but this can create a powerful opportunity for you, and I think you're probably starting to see where this could show up in your business. How can this break down specifically? Well, there's 2 kinds of tax: the business tax and the tax on the money that's coming to you. And anytime we have to take money out to pay for the flesh, it's going to be a lot more tax because there's also more state taxes and all kinds of other things like self-employment tax. But if we've set up our structure like we've talked about in other videos, you can make more than $1 million a year, and from that structure, you can borrow against it and get money virtually tax-free. If you're making less than $500,000 a year and more than $100,000 a year, that tax can be below 35% with the deployment of a sole proprietor S Corp in the state of domicile. And then if you're making less than $100,000 a year, your tax can be less than 20% overall, and most people are paying 40 to 50% tax. See, your C Corp is really your business's tax shield and liability spear. See, the C Corp isn't a double tax trap. It's like a financial alchemist that turns your 45 or 50% tax burden into 21% gold. We've been helping people in small to medium-sized businesses create these kinds of structures for years. First, we started with crypto traders who took their taxes from 50% on crypto down to below 19% on their capital gains. Then, as the business expanded to everyone who had a small to medium-sized business for the last 6 years, and we've been personally doing this for over 20 years with 0 issues. This isn't something that the powers that be want us talking about at all, this kind of structure. And to be honest, we only found about this big company strategy by fate when we were exposed to the corporate structure of 2 of the largest Hollywood distributors' corporate structures many years ago, because many of us used to work in Hollywood. And they want you to think you can't do this because you're too small. You have to be big to do this. But that's a lie. You can do this. Now, there's a link to my book here in the description that shows you exactly how and why we set up this simple structure of the C Corp LLC combo for your business. And that link is in the description. I hope to get your response to the book and to this video. And until then, be wealthy.